Hi, my name is Paul Kopesky. This is for Finance 452 with Dr. Cresson. This is my investment strategy. It's Dogs of the Dow. Dogs of the Dow is an investment strategy popularized by Michael B. O'Higgins in 1991. This suggests that an investor annually should select 10 of the Dow Jones Industrial Average stocks whose dividends are the highest fraction of their price. This is the Dow Jones logo. Who exactly are the dogs? The dogs that I chose are for 2013 to 2014. To the right, you can see a picture of the top stocks and the price, but along with their yields from 2012. This will show you how to choose the stocks you should use in 2013 to 14. These stocks include AT&T, Verizon, Intel, Merck, Hewlett-Packard, Pfizer, DuPont, General Electric, McDonald's, and Johnson & Johnson. This is a correlation matrix that I made in Excel using the returns from that calendar year, 2013 to 14. This shows how diversified a stock could be, and how a stock portfolio could be. It shows you the relationship between each stock along with all the rest of the stocks. So you can see here that Verizon and AT&T, perfect correlation would be 1. They're at 0.908, which is really close to 1. You'd expect this from these two companies, considering that they both sell the same products that are very similar, phones and services. This would be the highest correlation besides AT&T. Obviously, with AT&T, they're going to have a 1. But you don't want everything to be perfectly correlated, because when things go bad, since their relationship is the same, they're also going to go bad. But we're not here to talk about diversification. But I just wanted to show this and show how important it is. As for the prices, this is how I track them. I did weekly prices. I just pulled this data from Yahoo Finance. I went from January 2013 to January 2014. You can see that in each column I have the stocks that I chose. As for the returns, I kept the format the same from January to January. I computed a return by doing the ending stock price minus the beginning stock price over the beginning stock price. I took an average of each stock. As for AT&T, for the year, they returned 0.10%, and their risk was 3.40%. And at the end, you can see I made a portfolio average, and as a whole, this portfolio returned a 1.67%, and its risk was 4.92%. I'm going to use the S&P 500 as my benchmark as for how good we're going to do with this investment strategy. I tracked it the exact same way. I went from January 2013 to January 2014. You can see that I'm keeping prices. It's the exact same format. Once again, I calculated a return over the same time period. Just doing ending minus beginning over beginning. The return for the S&P for this year was 1.69%, and their risk was 2.37%. Slightly lower than the Dogs of the Dow. So this is a page that I can compare with. You can see each stock's return and risk. And you can see at the end S&P 500's return and risk. The portfolio as a whole has a return of 1.67, while the S&P has a return of 1.69. So the return for the S&P was higher. And if you look below that, it also has the risk listed. The risk for the portfolio was 4.92%, and the risk for the S&P was only 2.37%. So you can see here that the S&P gives you more return with less risk. This is what every investor wants. Yeah. Here's a way you can see it graphically. I have the efficient frontier drawn with a line, and my x-axis is risk, which is by standard deviation, and then on the y-axis I have return, which is the difference in the stock prices over time. The efficient frontier is where you want to be as an investor. You don't want to be taking on unnecessary risk. You want to be gaining a lot of return. You can see my legend to the right shows that all the orange dots are the stocks. The blue dot is the average, which is the portfolio return of these stocks, and this dot here along the efficient frontier would be the S&P 500. The reason it would be on the efficient frontier is because, like I said before, it actually has higher return but less risk. So you can see that this dot and this dot are pretty much even, but this dot takes on double the risk as this one. So you would never want to be here as an investor when you can be here. You want to be along this efficient frontier. So what is the conclusion from all this? The conclusion shows that the dogs of the Dow as an investment strategy returned less and was riskier than the S&P 500 index. As an investor, you would have been better off investing in the S&P 500 for the calendar year of 2013 to 14. However, the return that I'm using is calculated and only includes the change in price, and it does not include the dividends that were paid out. So as an investor, you would have to decide, are you an investor who is more interested in the stock price as your way of making your return, or are you worried about the dividend payouts along the way, the cash flows? So if you're worried about just the stock price, then you would want to go with the S&P 500. It's a lot safer and it has a higher return. If you're looking for dividends as your way to make your return, then you would have to do a totally different analysis that would include the dividends within the return. This would be the end of my presentation. Thank you for watching.